Hello, listeners. Welcome back to Cognitive Dissidents. As usual, I'm Jacob Shapiro. I'm your host. I'm a partner and director of geopolitical analysis at Cognitive Investments. Rob is joining me for the resumption of our weekly podcast chats. I am back from paternity leave. I'm a newly minted father. I have not slept very much, but we still put in an effort here to get the podcast to you guys as well. Give me a little bit of patience as we get the cadence of the podcast back up and running. We stacked a lot of episodes before my paternity leave so that you'd have some extra content on that end. I've got to get back into the system and get some things scheduled. So we'll try as much as possible to keep to our normal schedule, but it might take me a week or two to get back on track for our longer Monday conversations. But Rob and I are back with the weekly conversations. You can hit us up. Email me at jacob@cognitive.investments if you have any questions about the podcast itself or want to talk about what CI does. Otherwise, still plenty of time to leave some ratings and reviews. Cheers. Thank you for all the good wishes about becoming a dad. It's been really special. I appreciate it. We'll see you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. All right, listeners, for you, it may not feel like a hiatus, but this is the first time I've been sitting at a desk and in front of my microphone in a couple weeks. So I guess it's nice to be back, but forgive me ahead of time for the brain fog that's going to come from the lack of sleep from having a newborn. Rob, I'm going to depend on you to make sure I sound coherent in this podcast, okay?
I got your back, Jacob. How are you feeling in the new world of being a father?
I feel pretty good. The new world feels like the old world in some ways. I feel like I've always been precocious and an overachiever, so I feel like I was already prepared a little bit. But yeah, my biggest complaint is I had to go to Milwaukee for a day for a business trip this week, and I was telling you I got home at 11:30 at night to a flat tire in the airport parking lot. So there I was in the New Orleans airport trying to rush home to my newborn and my wife to help them out, and I'm sitting there changing a tire in the rain. So I'm sure there's a metaphor there for something. Maybe that's our metaphor for the Chinese economy that I'm searching for, changing tires in the airport at midnight, right?
The wheels are coming off.
Well, we're trying to put the wheels back on, I guess, but the lug nuts are rusted shut. There's a lot we can work with that metaphor, I think. But let's dive in. We shouldn't just update on the week. You and I haven't done a sort of weekly update in a couple weeks. So what has happened? First of all, what's happened while I was gone? It's been remarkable how the world keeps going even when you're sort of out of it. Which is both humbling and a little nerve-wracking as well. But it's also amazing how little to me has changed. I feel like I went offline for 2.5 weeks and we're all still basically having the same conversations about markets and global politics that we were a few weeks ago. So what's happened the last couple weeks that you think somebody like me who's been in La La Land should have in the front of their minds?
Yeah, it's funny how much things change in just a few weeks' time, and the whole narrative and what people are focused on tends to change. But then when you zoom out and look at the bigger charts, you see it's just a little zigzag within a much broader trend usually. Mm-hmm. And that's sort of what's been happening recently. So when you left 3 weeks ago, I believe you pretty much topped the market because since that time, the equity markets have pulled back. Yeah.
You're welcome. You're welcome, listeners, for topping the market. I'm happy to take credit for that.
I guess the market lost heart when it couldn't hear your voice anymore.
That's exactly it.
But we've retraced about half or more of the rebound that we've seen since the summer. And the big driver to that is the thing that everyone is talking about, which is interest rates and inflation, and the same story that we've been harping on about for quite a long time now. And really what happened was what a lot of people expected was going to happen, was that the Fed has come out and reiterated that it is not going to turn around on a dime and reduce interest rates anytime soon, that they're going to very aggressively fight against inflation, raise rates for as long as they need to, and very importantly, raise rates even if it means in the parlance of monetary policy, running the economy at below full capacity for an extended period. So, in other words, causing a recession. So, in markets, what you've seen is short-term interest rates have ripped in the 3 weeks since you've been gone. The dollar has ripped, and yet, kind of the interesting thing is that at the long end of the yield curve, you're not seeing the same sort of reaction. So if you look at the 1 or 2 year US Treasury yields, now the 1 year Treasury yield is about 3.55%, which is very high. And that's now higher than the 2 year, which is only 3.4 or so. These are moving around all the time, and we're recording on Thursday afternoon. So this may not be exactly right by the time people hear this. So you see that inversion now happening at the very short end of the curve. And the 10-year yield is 3.29. And that's important because it's still below the highs that we saw at the beginning of the summer. So they have come out and really, come guns blazing. And yet the long end of the yield curve is not reacting as much as one might expect. So that's rippling across currencies, of course, because the big driver of US dollar strength has been the fact that US short-term interest rates are very high, whereas in other developed markets, they've been quite low by comparison. So the dollar has really ripped against the Japanese yen. The euro fell briefly below parity. The British pound fell as low as 115 or so, which is the lowest it's been in about 10 years, I believe, or going back to 2008 even. And that's the big change, and equities took it on the chin. So the question now is, where do things go from here? The Fed has made its intentions very clear, and yet they haven't killed the market. We're still above those early summer lows. We're seeing a lot of strength across kind of more speculative areas of the market still. And that's where the debate is does the Fed choke off risk assets, or does the sort of inevitable deflation or disinflation that we're starting to see result in a better environment across the world? And we are starting to see disinflation, which, we like to make fun of the Fed here, and unjustly, because they're very smart and very well-meaning people. But they're playing an impossible game, which is pleasing politicians and people who are looking at backward data. And if you look at energy prices, oil has really started to crack, and West Texas crude oil is down to $82 a barrel. Industrial metals prices have really started to roll over. And we talked about copper before, but now you're starting to see it much more broadly in things like lead, tin, aluminum. And even if you look at weird stuff that doesn't really trade on an exchange that we like to track, like burlap and rubber, even those prices are really starting to roll over.
I didn't realize that we were tracking burlap that closely. That's news to me.
Oh, I got my finger on the pulse of the burlap market. Trust me.
It's funny that you say everybody's talking about interest rates, though, because when I was in my hotel room yesterday morning and I turned on Bloomberg, I mean, they literally for the first hour were talking about the dollar and talking about how the dollar was the strongest since 2002, and was this the top of the dollar, or was now the time to fade the dollar? And I wonder what you think of that. And also, I mean, one of the points that I think you've made for over and over to me, which is very insightful, is that the United States and the European Union and China are all moving in opposite directions. So the Fed is hiking, but the ECB is only just beginning to hike now. I don't really understand why the ECB. I mean, I understand why the ECB is hiking, but it seems to me that Europe's problems are related to the Russia-Ukraine war, and interest rates aren't going to do anything for the Russia-Ukraine war. And then China's continuing to circle the drain in ways that are starting to make me sort of even more nervous and put me in the sort of more bearish position you were in a couple of weeks ago. So I don't know. It seems like, have there been times in the last 2 or 3 decades where the 3 largest economies in the world we're all in fundamentally different positions? Because that's what it feels like right now. It's not just that the Fed is hiking, it's that the world is sort of off kilter and everybody's interests are mismatched.
Well, the short answer is no, because for most of the past 40 years or so, when FX rates were liberalized, you've seen synchronization between all the economies that mattered. And COVID, especially, I mean, this was diverging before, but COVID especially has just thrown a spanner in that.
Mm-hmm.
And now you're seeing the tectonic plates all moving in opposite directions, which is causing all this friction.
Yeah. What about Europe? Because Europe has kind of been that was the other thing that I sort of noticed when I came back to the real world in the last day or two, which was that everybody's talking about, oh, there's a European energy crisis and Russia just shut off the Nord Stream pipeline and they're not going to turn it back on until sanctions go away. And it seems like Europe and Russia are in the staring contest. And I feel like every single headline I see is about how Europe is in an imminent energy crisis. And yet, after that news about Russia and after the European Commission talked about capping the price of Russian natural gas prices started to swoon in Europe. And it's hard for me to make sense of. On the one hand, you have this very loud camp on FinTwit that is saying, oh, Europe is going to collapse. They can't deal with this energy crisis. You've got the ECB coming out today and revising projections downwards. But then, you see news that like the Dutch just set up 2 floating LNG terminals in a port. Germany might have 3 more up and running before winter comes. Like, it seems to me like maybe they're going to stumble their way through it and become stronger on the back end. So I don't know, the Europe bashing and especially the euro falling below parity, it looks pretty juicy to me. I don't quite understand why. What am I missing there? Is there a bear case that I'm that's just totally flying over my head?
No, I think the bear case is the one that's obvious and everyone has been bashed on the head with it all summer, which is energy prices, scarcity, crisis, essentially. And as we've said many times, markets look 9 to 12 months in advance. So if you're short Europe or you're bearish on Europe because you have some view on natural gas prices, well, you missed the bus by about 6 months, which I think, isn't just me being snarky. If you look at market prices, the euro, yes, it briefly went below parity, but it's basically back to where it was in mid-June. So it's making this double bottom. The euro is not making new lows, which is really important. And a lot of emerging market currencies are also not making new lows, which you would expect with all this talk of the dollar and its incredible strength. The Indian rupee is not making a new low. What does that tell you? If the Indian rupee is not making a new low, then things can't be that bad. But I think the story in Europe is, how do they respond to what's obviously a problem? I think there's also in sort of a misconception over here when you live on Twitter and you're reading the front page of the newspaper that there's this crisis happening. So I spoke with someone in our network. You know who you are. I know you listen to this. In Berlin last week, I think I told you this. And I said, well, how are things in Berlin? Are people, running around with their hair on fire because of what's going on? He said, no, it's absolutely booming here. The restaurants, the retail stores, the beer gardens, everyone is out spending money. You would never know that there's a crisis happening, which we've talked about before with travel and the tourism sector being so strong this summer. But even if you look at the data, like the German industrial production data came out earlier this week, and of course the number was not good. But if you look within the data, like the areas that are not good are the ones that are literally choked by the lack of gas. So like chemicals and petrochemical sort of areas. And capital goods orders and activity is actually rebounding from where it was the prior month or two. And the data in France and the data in Italy, for example, continues to look really resilient. So yes, there's a crisis, but it's not reflecting itself in some sort of perpetuating spiral into this deep depression. You can see markets and even real economic actors starting to anticipate, like, okay, well, where does this go from here? And I think that's what people should focus on.
Yeah. I mean, it's impossible to do this thought exercise, but what if Russia hadn't invaded Ukraine? I mean, what do you think the European economy would look like if they had normal natural gas prices? Would it be booming?
Well, I think the tourism sector would be booming no matter what, because that was pent-up demand related to COVID. I'm not sure. I think in the short term, it would obviously be better because you wouldn't have this crisis to deal with. But I think in the medium term, you'd probably end up on a growth trajectory that was even lower because you don't get the galvanizing effect of everything that's happening to focus minds and focus investment dollars and get the Bundestag to authorize $100 billion in military spending and all of these things that are starting to dig in terms of driving growth.
Yeah. The other thing with the focus on energy, which I don't want to downplay the importance of energy, it's a really big problem. And I mean, we're going to see the energy ministers are meeting tomorrow. The European Commission President von der Leyen came out with this 5-point plan about what Europe was going to do in response to Russia. Not all of the European countries are on board with it. Hungary and Slovakia have already been saying, we don't like this Russian price cap. I don't know if you saw the Italians in the polls are like, screw the Russian price cap. We want a price cap on all natural gas coming in. Let's go full Monty on this thing. So there are some disagreements to come through there. But I think one of the things that's been obscured is this heat wave and this drought that continues to be hitting Europe as well. I was reading sort of the European, I forget what the agency is called that looks at this stuff, but they came out and said it was the worst drought in Europe in 500 years. And when you look at the pictures of like the Loire River and its tributaries in France or some of these rivers in Germany and Italy, I mean, it's really, really stark. And natural gas, like it's all about let's build some floating LNG terminals and source new supplies. Like you can't control the weather. And I don't know whether it's grain prices now sort of creeping back up because Putin criticized the grain deal and you've got the impact of these higher temperatures starting to come to fore. I think that worries me a little bit more in terms of what's happening in Europe right now, even than the energy stuff, but nobody's really talking about that. You really have to scrape the barrel if you want to find news about that.
Yeah, there was a piece today where they were updating the expectations. So right now we're in El Nino.
No, we're in La Nina. I'm sorry. Double dip.
I have it backwards. We're in La Nina, and there was an expectation in some quarters that we were going to transition into El Nino perhaps as early as this autumn, which would mean more rain in the US and Europe and sort of a change to cooler temperatures. And now they've changed that forecast where they're expecting La Nina to persist for longer than previously into next year. So there's no obvious respite on the horizon for that.
Yeah, it's going to be a rare triple dip La Nina, which also, I mean, here in New Orleans, like usually La Nina means an active hurricane season. We have, knock on wood, not had a hurricane come anywhere close here to the United States. And we're in the middle of September. Apparently that's due to some like Saharan dust cloud or something that is preventing storms from forming off the coast of Africa. Can we just pump Saharan dust into the atmosphere to get rid of hurricanes in perpetuity? Like that doesn't seem like that hard of a thing, right? If we can make snow on mountains, why can't we pump? I'm sure there's some reason why that's completely unrealistic, but I'm starting to have dreams of terraforming and New Orleans never facing hurricanes again. But now I'm rambling. But yeah, I think it's going to be triple dip La Nina. But triple dip La Nina also means things like drought in South America is going to continue to be expanded, higher risk of flooding in Southeast Asia, places like Indonesia, Australia. I mean, all of those things can kind of affect things on the back end. Before we become, weather experts here, I think we have to turn and talk about the dragon in the room that nobody's talking about, which is China. We sort of alluded to it briefly. I was sharing with you before we hit the record button here that I'm having a hard time in my head sort of thinking about the next couple months and what China's role in it is. Because if China really is facing a crisis and it's doing this thing where they say they're going to have a lot of stimulus, but then in practice, the stimulus seems to be not effective or is less than what they're talking about, or the horse isn't drinking, to use your metaphor. It seems to me that's going to lead to commodity prices collapsing and, lower trade. It comes with all these attendant things. But if China can sort of put the pieces back together, then that's a completely different it's a completely different macro environment and a completely different geopolitical environment. And it's one of these rare cases where I feel like those are two mutually exclusive scenarios. Like either China is going to sing or China is going to fall in the next couple months. And I'm having trouble figuring out which one it is and then how to think about the next 3 months. So where are you right now on China and what you're seeing?
My view hasn't changed too much since we last spoke about this, which is the longer time goes on, the more worried I get, because I think there's a time decay element here that a lot of people don't pay enough attention to, which is the longer you go where you're sort of just scotch taping things together and keeping things up, or keeping things from collapsing with whatever kind of moderate stimulus they've introduced, which doesn't appear to really be flowing through very much.
Right.
The longer that goes on, the more dangerous it becomes, because everything is about expectations. And expectations are tied to time. So if people are sitting there and you're expecting them to, reinitiate essentially bubble-like conditions for housing, and they're sitting there for months and things are kind of languishing, that's an important factor. So that really worries me. And I don't know any better than you do what's going on behind the scenes, but my speculation would be that there's a lot of uncertainty about what to do, that they know that, stomping on the accelerator for stimulus even more than they have been, even if it did work, which is not even certain that it would right now, because they're having trouble getting individual actors to actually step up and do stuff. But even if they did that, I think there's sort of the recognition broadly that that's not a good idea. And ahead of the meeting in October, I think there's just a lot of, let's just keep the wheels from totally falling off until then and then see where we are. That's worrisome. The prices of burlap are falling, and I think that's reflective of this slowdown.
It all comes back to burlap. We should just make this a podcast exclusively about the burlap market. I'm sure that would do well.
Well, they say niche podcasts are where it's at. So.
Yeah, well, it can be a little too niche. Well, how we've sort of been, I don't want to say sitting on sidelines, we have some open positions in China right now. How are you thinking about positioning now in terms of waiting for the other shoe to drop with China? Is it still just kind of a watch and see mode, or are you beginning to think the longer this goes on that we need to make some changes or sort of think about it? Because if China really is going to go that direction, it also has second and third derivative effects, it seems to me, that we also have to be ready for. And it seems like now would be the time to position if something is going to go ahead. So where are you at sort of mentally about how to prepare for the uncertainty that's coming with China, or that China's sort of the uncertainty that China's injecting into the system right now?
Well, we sold more than half of our Chinese broad exposure earlier in the summer when we first started worrying about this. But after we did the initial podcast about China and the treadmill to hell, which Steve was pointing out, ironically, that most people go on and talk their book when they're speaking publicly. We actually talk against our book, which is not exactly standard practice. But we have some modest exposure, like very small, and then our largest single equity exposure is in Tencent, which is definitely beating to its own drum as far as the story and the narrative around that. And that had been getting the crap beaten out of it long before any of this stuff was on the horizon. Mm-hmm. So we don't have too much. I mean, most of our exposure in Asia, from a top-down perspective, is concentrated in Japan right now, which has held up remarkably well, and which is actually seeing reacceleration in its own domestic credit growth. The numbers came out just yesterday showing that Japanese bank credit is really beginning to reaccelerate again. Prior to COVID, it had been accelerating in a very nice way, and a lot of people were speculating that they were exiting from their deflationary trap and those sorts of things. And now we're seemingly back on a fairly good growth trajectory, which is interesting. And there was some commentary about that being tied to property investment and M&A, and not the stuff that you would usually expect. So they seem to be bucking the China slowdown, which is an interesting divergence, right?
Well, especially interesting because the Japanese economy is still so exposed to China as well. It kind of doesn't make sense that Japan would be kind of rolling when China's not doing particularly well, because I still think of Japan being pretty well integrated into the Chinese economy, at least from a trade perspective. I'm going to check those stats now while you give us some brilliant insights about that.
Well, they definitely are, which is why it's interesting, because a lot of other, indicators that we follow. So I always talk about iron ore prices. Iron ore prices look ugly. Chinese junk bonds are holding up, but they're still fairly close to the lows. Like, there's not a lot of indicators that markets are telling us that China is improving. And yet, if you look at Japanese equities and Japanese, macro fundamentals, like the topics is holding up extremely well. The Japanese stock index. If you look at a company like Nippon Steel, which I think is 5401 on the Japanese exchange, that's close to making a 12-month high. So those are weird outliers, and I'm not sure what to attribute them to, whether it's expectation of domestic-driven growth in Japan, or if it's something else. I don't know, but it's an important data point to pay attention to because it's such a divergent one.
22% of Japanese exports to China last year. I just looked that up. Where does the yen fit into all this? Because the yen keeps crashing through new psychological barriers. I think it's flirting with 145 right now, I think, as we're recording. How are you feeling about the yen? Do you think the yen has something to do with Japanese equities outperforming? It obviously is tied into the interest rate thing, and I think we've been expecting that to reverse itself, and so far it really hasn't.
I'm not sure how tied it is to Japanese equities anymore. Years ago, that used to be the case where they had almost this one-to-one relationship, but you've seen that correlation break down a lot, especially post-COVID. And even if you look at the kind of day-to-day moves, it's not that Japanese equities are necessarily ripping when the yen is down and vice versa. They're kind of moving in line with equities more broadly. And equities more broadly have been moving opposite to the yen. So remember, dollar yen is being driven by interest rate expectations in the US, which, since you went on leave 3 weeks ago and came back, have absolutely gone through the roof because they've, as we mentioned, clamped down on the brakes and made their intentions clear, which has driven the dollar up and equities down. So I don't think that relationship is so strong anymore. The yen is essentially moving in line with U.S. interest rates and long-term U.S. bond yields. And I think looking at the yen on the long side is still one of the most interesting trades you can consider out there right now. Because bond yields, the 10-year yield, for example, is not making a new high compared to the spike that it made. I think it was in June. I don't have the chart in front of me. But the yen is, which suggests to me that that's potentially an overshoot. And if you look at what the yen has done historically, it has these periods where it weakens, and then you just get a face-ripping rally in the opposite direction, where you have these big moves. And I wouldn't, just in full disclosure, we cut our yen position to a small stub after it started going against us. I don't know, shortly after you left, and but that's something that I would consider putting on again here in anticipation of one of those moves.
What about the yuan? Because the yuan has also been weakening, and it seems like China's been intervening a little bit to try and at least shore it up and prevent it from going to 7 on the dollar. Does that have a similar dynamic to Japan, or is it really doing different things?
The yuan is a real tricky customer because it's a closely managed exchange rate. There's a capital flight issue at work in China that works differently from Japan, because Japan is a liberalized society, at least as far as its capital account goes. So if you're a Japanese saver, you can go and buy, U.S. assets or buy U.S. Treasury bonds when the yield goes up, and those things flow pretty smoothly. Whereas China does not want wealthy Chinese people getting their money out of the country and taking their capital and converting it into other currencies. So there's sort of a pent-up flight demand there that's very difficult to gauge. I think there's a sort of common view of the yuan as acting in almost like the way that an emerging market currency would act, where people think you're going to get this collapse in the yuan. I don't think that that's very likely at all. China is one of the very small handful of countries in the world that has deep and liquid enough capital markets that it can fund itself. It's not dependent on outsiders to finance it. So you're unlikely to get these sort of sudden stop things, even if the worst case scenario happens and you get a major slowdown and rollover and essentially collapse in Chinese growth and the property market and commodity demand. You may see yuan weakness, but I wouldn't expect a massive, Thai baht in 1997 type move, and if that's what people are looking for.
Well, that seems to be it's weird how the media just puts in these different crises to stand in. Like it's like Asian financial crisis is in the first paragraph of every article as soon as the yuan starts weakening. It's like a formulaic thing, I guess. Before we turn maybe to North America, I thought we should talk a little bit about what happened in Chile. I'm not sure if listeners have been following Chile that closely, but they had their constitutional referendum on Sunday, and it went very badly. Well, I shouldn't say it went very badly. A majority of Chileans said they didn't like the constitutional draft. And ironically, Chilean equities seemed to rip for a second, although they've come kind of back down to where they were right before the thing started. I know also we took some gains off of our Chile position earlier, I guess in July, when the Chilean peso was kind of rebounding a little bit. But any thoughts on Chile or any questions about Chile? Because a lot's been happening there.
The thing that strikes me about Chile is they're one of the most aggressive countries in the world right now in terms of raising interest rates. Mm-hmm. Rates are now at almost 11%, and they've been moving very actively to do that in order to, in part, defend the peso. And yet at the same time, the thing that Chile enjoyed prior to all of this was that it essentially had developed market levels of inflation and interest rates, and it was a quote-unquote normal country. And I just wonder if they're making a similar mistake where they're jacking up interest rates right as commodity prices are starting to roll over, energy prices are peaking. I don't know if Chile has to be like Brazil, in other words, in its interest rate policy. And that might show itself as some of these more volatile elements of inflation start to normalize, if that makes sense.
It does. I think lost in the focus on the domestic politics is that the Chilean government, a week or two before the referendum, made an agreement with the IMF for a flexible line of credit for $18.5 billion. The language was to augment buffers and provide insurance against adverse scenarios. And it's just a quote unquote precautionary credit line. But the fact that this Chilean government was so nervous about kind of what the situation looks like over the next 1 to 2 year time horizon, that not only are they hiking interest rates, like you said, but they're going to the IMF and they want to have billions just in case there is a deeper run. That also all of my spidey senses about China started going up there too, because I mean, Chile is extremely exposed to China from a trade perspective, and especially on copper and things like that. So in some ways, that worries me a lot more about what's going to happen here for Chile in the next month or two than the Constitution drama. It might actually also create a compelling risk reward at some point if things really do go off the rails in China, and Chile is going to take that on the chin, because I think that'll be one of the first. I think Chile is one of the first warning posts for if things really are bad with China. There was one report I saw that one of the major Chinese copper importers was actually delaying payments on imports of copper because they were having liquidity issues. That set off a bunch of alarm bells in my mind too. If I'm Chile, I'd be freaking out over the idea that the Chinese can't pay up front for some of the copper that they're importing.
Well, there's a pretty compelling bull case about copper that's really more about EVs and sort of new energy technologies and the demand driven around those, and less about China, which is worth keeping in mind, just because if you do get a real disaster scenario in China, it's not like all hope is lost for the copper market and for Chileans more generally, because that's a market that's changing a bit. And you can see that just in the way that copper's trading. Like, copper's been actually pretty strong in the last few weeks, whereas industrial metals otherwise have not looked very good. And I just wonder if you're starting to see some of that difference play out.
Well, that's a good segue into what you wanted to talk about in terms of the Inflation Reduction Act, because I would have said that my sense is that, yes, copper is one of those metals that is critical for EVs and for the energy transition, but it doesn't seem to me that the demand for those things can pick up for China quickly. Like, maybe over the next 3 to 5 years, yes, you could have that sort of ballast to the copper market. But I mean, let's take Chile as an example. Something like a third of Chile's exports go to China. And when you go to the copper exports, it starts getting up to 40, 50%, sometimes higher if it's just the ore itself. So it doesn't seem to me that the rest of the world is going to suddenly come in and make up for China building ghost cities and perpetuating its real estate development scheme forever. But maybe I'm underestimating that. And I think you heard some things about the Inflation Reduction Act that made you perhaps a little more bullish on demand, maybe in the U.S. and developed economies for some of these metals.
I don't know if bullish is the right word, but it's something that I think the team is definitely paying a lot of attention to, and which I don't think is getting very much press in the current environment, which is this upcoming permitting bill being debated this week. And the background to this was, so there's been some news reports hitting the wires about investment projects that are going ahead that are related to the Inflation Reduction Act because of the incentives that were put in place, especially around clean energy and things like that. So companies like First Solar, for example, which had previously given guidance for the year that was fairly benign as far as building out new solar capacity. So they do utility scale solar facilities. They turned around on a dime after the Inflation Reduction Act was passed and amped up their CapEx budget for the year and said, we're going to build, I forget what the number is, but a significant amount of new solar capacity right away. And we spoke with someone in our network who is a very experienced consultant, and he's running the arm of a larger consulting firm focused on helping large, mostly multinational corporations sort of navigate the transition to new forms of energy and sort of greening their operations and reducing their carbon footprints and things like that. His business is booming, by the way. And he mentioned to us recently that his firm had really dug through this Inflation Reduction Act, which is a very complex bill, and you need to really spend some significant time with it to understand what the heck is in there. But that the more they dug into it, the more they realized this is potentially going to see a boom in investment. And this contact is a fairly level-headed person, and he was comparing it to New Deal-like proportions of investment in infrastructure and grid technology and power lines and renewable generation and fleet upgrades and all these sorts of things. So to give one example, he mentioned he has a client who's considering a $150 million project that they're going to do. And under the previous regime, they were going to get $4 million of incentives to do this. And with the passage of the Inflation Reduction Act, it's going to be $40 million of incentives. So naturally, these guys are amping up their spending, which brings us back to this permitting issue. And this is why I think this is so critical, because we've talked about this many times, this notion of it's very difficult to build. And about a month ago, I mentioned we saw an interesting piece from Royal Bank of Canada where they were pointing out that the backlog for environmental permitting for new renewable generation had extended from about 1 year 3 or 4 years ago to now it's 2 to 4 years.
Yeah.
So in other words, if you green light a project today, it's going to be 2 or 3 years before you can even get a shovel in the ground by the time all of the permitting and environmental assessments and everything have been done. So that's all great if you are incenting greater investment. But if you can't get the permits done, then it's not going to do much in the short term, except, enrich some planners and architects and stuff like that. So this permitting bill is really something that people should be watching very closely, because it's not clear what it's going to be in the end. I've read some comments from people in Congress saying that it essentially looked very toothless and that it wasn't going to do much. And obviously the environmental lobby is very much against it because it's going to result in more pipelines being built and things that cause a lot of controversy. But we should know by the end of this week kind of what it might look like. And that's something to pay attention to.
Yeah, I admit to having a certain degree of cynicism about the U.S. government's ability to do these types of things. And I mean, just 2 examples from the past couple of weeks. The first is that, we did that podcast on water. What was that, a month ago now? I can't believe that was a month ago now. And we were talking about how August 16th was this drop dead deadline where the federal government was telling all the states in the Colorado River, you're gonna have to make some cuts and agree amongst yourself who's going to cut water usage, or the federal government's going to come in and make the cuts for you. Well, August 16th came and went, and the federal government came in and said, well, you guys haven't made any agreements, but we're not going to do anything to you yet. We're going to give you a couple more months to figure this out amongst yourselves, which to me sort of said, so you were bluffing and they didn't listen to you. They called the bluff, and now we're just in sort of no man's land. And this is, drinking water for 40 million people. U.S. agriculture depends on this water. We've got, if you just look at the satellite images of Lake Mead, it's a catastrophe now. There's like no urgency at that level, even if the federal government was talking about it. Another example, which is the flooding that's been happening in Jackson, Mississippi recently. It's not the flooding itself that has me interested, but the water treatment plants there failed. Because for years, decades even, they've known that their water treatment plants are out of date. The Democrats in Jackson, the city itself, been fighting with the Republicans at the state level, and everybody's pointing fingers at, we should have had more help from Washington, and we should have had more help from the state, and we should have had more help from the city. Meanwhile, a major metropolitan city in the United States, even if it is in Mississippi, doesn't have drinking water right now. And who knows when it's going to have drinking water. And this is an easy fix. This is a water treatment plant. It doesn't take that much work. Like, somebody just needs to do it. So I think you're right to say we need to see what happens with the bill and see what gets through, and maybe things can be paradigm shifting. But the U.S. government's recent track record on fast tracking these types of things or on doing infrastructure is just not very good. I was having a conversation yesterday with somebody at breakfast about how authoritarian governments like China, this is the stuff they do really well. They do big infrastructure projects where they don't have to listen to objections from this, that, and the other party or Joe Manchin or anybody else. They just get it done. They're worse on the innovation side of the economy. Like, it's not like China was producing the COVID-19 vaccine. So here in the United States, we produce COVID-19 vaccines, but we don't have water treatment plants. In China, they're literally moving rivers here and there with massive dams, but they can't figure out innovation and things like that. There's just something in there, and I'm not sure that with this Congress, with the Democrats having such a razor thin majority, that they're going to be able to push anything through that does have any teeth. But I would love to be wrong about that, and if I am wrong about that, I think you're right. It would be transformative.
But I think it gets back to the conversation we were having earlier about Europe and what is galvanizing them into doing stuff. And it's a sense of urgency, a sense of crisis. And I don't think that sense of crisis really exists in the US. No. There's some equilibrium that's established itself for a long time now where we just can't build a lot of stuff. We just can't muster the will to, overcome resistance by whatever interest groups or whatever. And I don't see that changing. Whereas in Europe, there's a sense of emergency that is becoming more acute, not less acute, which is why I think I'd be more optimistic about them doing things like this. Getting back to my Paris bike lane versus Cambridge, Massachusetts bike lane example from a few weeks ago, which I'm still annoyed about.
Well, we have some Dutch disease in the United States too. Because of the Shell Revolution, we have cheap energy. And Europe doesn't have cheap energy right now. And so Europe is going to do the things right now to maybe get cheap energy going in the future. But in the United States, like it's one thing to say you want the clean energy transition, but when you have natural gas as plentiful as it is in the United States and as cheap as it has been relative to the rest of the world, it's hard to produce that kind of urgency. It's also one of the reasons, this idea that the United States is going to come to Europe's rescue with natural gas and LNG exports. I don't know about that. I mean, I know that a lot of I know that in the US, the industry wants to export abroad, but you're talking about raising natural gas prices for Americans to do that. You're talking about globalizing a market that really isn't globalized yet. And I don't know. I haven't seen a U.S. president yet who's willing to do that sort of thing, to triple U.S. energy prices so that Europe can have cheaper energy. I don't know that works, but that might have something to do with it. We discovered oil and natural gas via shale, sort of. Maybe that has something to do with the complacency that the U.S. is feeling.
Well, no podcast would be complete without an ancient history reference. And it's worth pointing out that the final words in Herodotus are the story about Cyrus in the early days of the Persian Empire, where his henchmen around him say, okay, well, now we've got some money. Let's move to this new area where the crops are plentiful and life is easier. And it's just easier to get stuff out of the earth. And he says, well, yeah, you can go do that, but prepare to be ruled by others because easy living creates easy people. And there's something to be said for that, where scarcity sharpens and focuses minds, which is what we're sort of seeing play out right now.
Yeah. What else? Anything else on your mind that we haven't hit yet, Rob, or is that enough for the listeners on our first week back?
Actually, there was one thing I had written down I wanted to ask you about, not to get totally in a different part of the world, but what do you think about Pakistan right now? I know we had the floods, which were briefly covered in the press, but in the midst of everything else, they sort of were, page 6 material. But that seems like a major catastrophe from my sort of distant viewpoint. And I wonder if you have any updated thoughts.
I do. You can go on NASA's website and look at the satellite images of the flooding in Pakistan. It's absolutely extraordinarily horrific. It's sort of, you get like a picture of green, and then next to it, like the level of flooding, it's really hard to exaggerate. I'd encourage you guys to all go look at a picture. I gave a talk to an audience yesterday, and I showed them that slide, and you could hear the gasps in the room. That's how kind of stark the flooding situation is. And we should also say about Pakistan, just your average country with over 200 million people and nuclear weapons, not a big deal. It's not like it's that important or anything in the world. So it keeps me up at night a lot. I'll say though that I think they have maybe, or I should say, I think Pakistan has 2 or 3 things maybe going for it right now that it didn't have before. Number one, the flooding gives them some sympathy with their creditors and with the IMF. So before, they were going to the IMF because they had the heat wave and the energy crisis and the balance of payments crisis, and you had this government in Pakistan Pakistan that love to just shit on the West and the IMF and have these conspiracy theories. So Imran Khan is gone. He's in the opposition. He's causing problems in the opposition. But you have a Pakistani government that's been trying to make nice with the IMF, and then they get hit by this flooding. So I think that there is, some argument there when they're in their negotiations with the IMF. They're like, come on, guys, you can't really expect us to do what you were expecting us to do 2 weeks ago. You've seen the flooding situation that we're at. We need a little bit of a break here. The second thing is that the lower energy prices and food prices and commodity prices go, the better it is for Pakistan. Their problem is that they haven't been able to import or reliably import energy and food from abroad, in part because the Europeans are on the market and they're stealing everything up. And if you're selling LNG, probably rather sell to the Europeans than the Pakistanis, because you don't think the Pakistanis are going to be able to pay up. So if the Chinese slowdown actually manifests a little bit and starts to manifest in lower energy prices and lower food prices, that gives Pakistan some breathing room, because then maybe they can import at a lower cost, or maybe there's some way forward for them to kind of piece it all together. So I think that's where we're at right now. If you'd had the flooding and oil was still 120 a barrel, you'd probably be in a much worse situation in Pakistan than you are going forward. Right now, energy prices have come off the boil. I think wheat prices I saw were down about 40% even after the recent tick up. That's happening at the right time for Pakistan. So I think that's given them a little bit of a reprieve. But the situation there is not good. And that's without getting into the domestic politics, because this government that's in there right now is more of a technocratic government, and it's facing, Imran Khan's opposition is coming back, and they're talking about, did he do something illegal, and going after him with legal means or with the judiciary. So there's just a lot of a mess there. And then I guess just the last thing I would say is that, and this applies to India too. I mean, so much of Pakistan and India depends on the monsoon cycle, and climate change is going to affect a lot of different parts of the world in lots of different ways. We just talked about flooding in Mississippi and, water scarcity issues on the Colorado River. But I don't think there's perhaps any pair of countries or region in the world that is going to be more affected by climate change in the immediate term than India and Pakistan and the subcontinent, because they depend on the monsoon cycle. And we're already seeing that climate change is leading to the monsoon cycle starting late or ending early or having more intense rain in periods. It's becoming even less predictable than before. And so you get these heat waves followed by these floods, followed by all these crises. And that's just difficult for two countries that really don't have great infrastructure and have a lot of poverty and are importing lots of things from abroad. So that's where I'm at with Pakistan. I think they've had a little bit of a reprieve, but the situation there doesn't seem very good going forward.
Well, sorry to end it on a down note.
Well, I mean, you could maybe we're ticking the bottom there in Pakistan, though, too. I mean, there's one Pakistan ETF out there I keep my eyes on. It's ticking bottoms and stuff like that. And both, like I said, Pakistan, hundreds of millions of people, there's a lot of human capital there that I think has been wasted in that political system. So it wouldn't take a whole heck of a lot if you could just get Pakistan to a base level of competence for Pakistan to use some of its advantages to move forward. They've also, I mean, ironically, the Chinese have given them a lot of money. The U.S. still wants to have a relationship with Pakistan. They have a relationship with Russia. I think it was sort of, it wasn't as intentional as Turkey, but they're one of these countries that seems to be able to play all sides. Now, they've done it to sort of borrow too much money and not use it constructively. But if you can be that kind of country that other countries want to be involved with and want to have strategic relations with you, and you can play that off of each other, and you can use a young population that is consuming more and more things, there's some building blocks there of something to get better. But I mean, the story for Pakistan since it became a state was just sort of garden variety government incompetence and corruption, and what is the role of the military versus the civilian government versus the intelligence agencies, and all of that stuff is still pretty unresolved and still pretty messy. So
I think the point about human capital is interesting and highlights a bigger theme that we've talked about, which is sort of unlocking even portions of countries and their capabilities through, new technologies and communication abilities for them to integrate in the global economy in ways that they couldn't before. So, like, for example, parts of the Indian technology industry, I can see doing extremely well over the next 10 years, even if India as a whole does not particularly do great at the broad level. And Pakistan, I think, probably falls into a similar bucket. Would you agree?
Yeah, I mean, yes, it does. Remember too. Also, when India originally became independent, both Pakistan and Bangladesh were part of sort of British India. So, I mean, imagine if you could put all three of those economies of scale together. The subcontinent has sort of slowly been subdividing itself into these little pockets against each other, and all these countries bash against each other in different ways, and even fight these little border skirmishes as well. So, I mean, the subcontinent has sort of been a punching below its weight in general. Somebody asked me in the talk I gave yesterday why I sort of punted on India yesterday, because I always punt on India because I never really know what to say about India. But they asked me why I was pessimistic about India. And, I can trot out the GDP per capita in India is roughly equivalent to GDP per capita in Haiti, which is only one of the poorest, most corrupt countries in the entire world. So even if you have all of this great human capital, if you've got a society where people are living at sort of Haitian levels of subsistence, like that's not a recipe for success going forward. And the other problem I think that countries like India and Pakistan will have is that, the playbook they want to use is the Chinese playbook or the South Korean playbook or the Japan playbook. Like that's the one you want to employ. But that playbook, or Taiwan is another example, that playbook requires globalization. You need to be able to sort of attract the investment and get the technology and the know-how and become that low-cost producer. And neither India or Pakistan is moving in that direction. India is becoming more protectionist. They're talking about being their own center of gravity. They're behaving like China today, even though their economy is more like China 40 years ago. So I'm not sure that the macro environment will make it as easy for those countries to take off, because they're starting from such a low base, and they are so geopolitically suspicious of what's going on sort of internally. If we saw a resumption of globalization on some level, or if, let's say, I don't know if you saw this, like India and Japan are having some big security meetings this week. If like Japan and India decided they were going to be best friends, now you have some like interesting things that are happening there. But I don't think it's going to happen the same way it happened in some of those other Asian economic miracles, just because of the demise of globalization in the current environment.
Well, I think part of it too is not just globalization, in that the Asian growth miracles are all, in some ways export led.
Mm-hmm.
I think the bigger thing is, if you look at all of those cases, the key to their success in Japan and Korea and China was capital discipline.
Yeah.
So, like, if you look at Japan, and you can read about this in like MIDI and the Japanese Miracle and books like that, kind of discussing how they accomplished this feat, in the 60s and 70s in particular. It was through sort of this discipline combined with control. So, give the capital to the companies that are figuring out how to move up the value chain, and incent them to do so. And when they stop doing that, you strangle them and give it to someone else. And, if you look at other countries, that's very hard to do. Mm-hmm. It's very hard to have a system that can sort of identify and incent that kind of moving up the value chain and competing in export markets, and yet retain the independence to not be captured by the people running those companies themselves, if that makes sense. So, like, if you look at Turkey, for example, they tried to do this in the 1960s. They had something called the Strategic Planning Office, I think it was, in 1960, after they had a coup in the military sort of tried to follow the East Asian model. And it was not, they didn't have the centralization enough to enforce the discipline that you need. And it ended up being kind of captured by the companies themselves, and they, skewed the incentives to benefit themselves. And they never really had the rod at their back to kill off the ones that are not successful and feed the ones that were. And I would imagine that that's a big problem in places like India and Pakistan as well, because you need a strong centralized authority to follow that model successfully. And that's something that they definitely are lacking, at least right now.
Yep. And I mean, for better and for worse. I mean, India is the world's largest democracy. That comes with certain pitfalls. I mean, because democracy can bring you good things, but it can also mean in these pivotal moments, you don't have that kind of discipline. I mean, China doesn't get where it is today if Deng Xiaoping isn't the paramount leader and gets everybody marching to the exact same beat of his drum. Even Narendra Modi, who has really been a revelation in terms of his popular support in India, he hasn't been able to actually follow through on most of his reforms, even though he's sort of thinking and saying a lot of the right things. So,
yeah. And then if you look at the CEOs of, something like the top 12 U.S. technology companies, something like 85% of them are of Indian descent or heritage, or they're Indian immigrants. So there's certain positives that get unlocked with that approach that somewhat compensate in terms of creativity and innovation, I think.
Yeah. I mean, the United States probably wouldn't have done as well as it did if it wasn't just gifted the Mississippi River complex. India doesn't have anything like that. It has to do all the infrastructure from scratch. So it can't sort of just have this low cost of moving things around and stitch the country together like the United States have. If the United States, if the English settlers had been in India, not in the United States, probably wouldn't have developed into the country that it is today. It probably would look a lot like India's right now. So this also goes back to sort of structural geography and how in some ways democracies do need, well, I don't want to say that's painting with too broad of a brush. I just want to say that India's geography is particularly challenging for creating a unified state. It always has been. It probably always will be. All right.
Shall we call it quits there?
Let's call it quits there. We will see you guys next week. Cheers. Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.